For more on the markets, we cross to Nompumelelo Siziba. She's standing by at the Johannesburg Stock Exchange. Good afternoon, Nompumelelo. How are the markets looking as we end off the week?
Thanks very much, Nzinga. Well, the markets are looking quite interesting, somewhat mixed today, but generally the bias is downwards. So there are a lot of things happening. You know, there are those US-China trade talks going on. And just to touch on that $200 billion concession in terms of cutting, China supposedly being willing to cut their surplus with the United States. I think their surplus is currently around $350 billion US dollars. And it's claimed that they said that they would be willing to cut 200 billion. But now Chinese officials are saying that's absolutely not the case at all. So everything is still up in the air. I think there's still a lot of room for us to hear the facts, because of course they're still meeting and there's a lot of rumor going on, a lot of anticipation. So markets worried about that on the one hand. Markets also worried about higher interest rates in the United States, that 10-year US Treasury yield going through 3.1%, and concerns that means that the Fed will continue to raise rates, which will be adverse for emerging market countries like South Africa, of course. Doesn't help that we have twin deficits, that is a deficit at the trade level and also a deficit at the fiscal level. So those issues don't bode well in our favor. And then, of course, the other issue that is really negative for us is that high oil price. It's still hovering close to $80 a barrel. And of course, with the weaker rand, it means that we're going to continue to import inflation going forward. Let's take a look at the indicators. I'm joined by Warwick Lucas. He's from Galileo Capital. Thanks for joining us, sir.
My pleasure.
Good stuff. Global markets looking somewhat mixed today, but what would you say has been the week's trend and the key drivers?
Okay, so I think it's been a time of year now when you actually traditionally get some slightly lower returns. In any case, I think historically, if one looks back, certainly on the US market and here inflation adjusted, May to August is typically a bit of a dog. So I think that's part of the drivers. The other has been the issue of strong dollar and oil prices are featuring quite large.
And then those trade talks, everything is still pretty much up in the air, isn't it? Or have you heard anything recently?
I think a lot of water to tread there. I mean, so we see the $200 billion trade deficit also being niggled over as well. But I think in terms of the actual trade war, I mean, well, China to some degree has won that substantially in the past. And I think that they have been over-trading on the emerging market credentials really for quite some time. I mean, they've been able to recycle their foreign earnings into a US bond market that was basically a one-way bet. It just got better and better, and also supported the dollar, and so it sort of recycled. That dynamic has also gone. So China is going to have to work quite a lot harder to actually persist with the kind of trade surplus that they've had.
A Trump sympathizer. Of course, that oil price, that has been the big news this week. What have your thoughts been around it, and what it could mean for emerging markets, particularly importing ones like us?
Okay, so one of the features of the last massive boom that we had in the oil price was that it led to substantial gains in energy efficiency generally across the world, not just for environmental reasons, but because of cost reasons. And we're now seeing that the global vehicle pool has now embraced all of this technology, and I think we now have an economy that is certainly much more resilient to say $100 oil than it would have been in the past. So I think there is some capacity to be able to absorb that. Certainly the story of Iran negotiations obviously being in the bush there, Venezuela, massive capacity problems there. Yeah, all of that is keeping the boil on the oil price.
Indeed it is. And then lastly, Richemont, that's pretty much the only result I saw. They came out with their annual results for the year ended March. They're very much a niche player, aren't they? Just tell us a bit about them and how they're doing.
Okay, so they fall into the category of what you'd call luxury goods. So two primary businesses there, jewellery and watchmaking. It was a business its earnings have been relatively stagnant the past few years. As it was, last year's earnings should have been a bit of a low base. So to see very little growth this year, apart from cash flows, I think is, to my mind, a little disappointing. And from consensus earnings, it also appears to be a miss. Combined with the need to buy back watches, because when you have a luxury good, you have to keep your stock fresh, fashionable, up to date. They wind up buying more stock than I think the market anticipated. Net result, the market, I think, not wildly happy with those results. So,
look, we still have a little bit of time. So just broadly speaking, as we see markets going up and down and so on and so forth, what do you say to viewers at home who have concerns about being invested and that philosophy of being invested for the long haul?
What I can say is that even if indices are going up, it doesn't mean that markets are riskless places. There's always risk in markets, and it's quite possible in a rising market to lose money, and one should stick to good basic principles. And in that particular case and in this particular market, I would say focus on what's paying proven dividend, good steady dividends, at a reasonable amount, i.e. a reasonably big coupon, and I think you should ride through reasonably well.
All right, okay. Well, thank you very much, Mr. Warwick Lucas, for your time as always. That was Warwick Lucas giving us his view on what's happening in the market this week. And after a short break, Nzinga will have more business news for you.